that's our borrower portal. Okay, there's really not much there for investors other than a link to take you to the investor portal. But since we're on the topic, that's where our borrowers start. Okay, and they come to us in a bunch of different ways, but I'll come back to all of that. Let's talk first of all about student debt and how YRefi fits into this picture. So, big picture, student loan debt is a 1.7, probably closer to 1.8 trillion dollar market. It's a massive market. I would rather call it a problem than a market. Now, YRefi does not do anything with federal student loans. Okay, so I'll address the conversation about federal student loan forgiveness in just a moment. We don't worry about it because the work we're doing is not in the federal student loan space. Pardon me. We work strictly with distressed private student loans. So of that 1.7-ish trillion dollars, about 200 billion is private loans, and of that, about 10%, 21 billion is distressed private. Now, what's interesting is there is a massive market already out there in distressed assets. Okay, consumer debt, distressed mortgages, you name it, it's probably out there. And when it comes to distressed private student loans, there is a market, but it's being handled in such a way where the borrowers are frankly just being tormented. Their credit gets decimated. They live a life in fear because student loans, both federal and private, are bankruptcy protected. So these borrowers don't have any options and a way to get out of the situation that they're in. So once they go into delinquency and ultimately into default, they find themselves all the way into garnishment proceedings, lawyers' offices, and that's a scary place to be. So YRefi, we step in the middle of that process and disrupt the flow, and we give the borrowers an opportunity to, in essence, rehabilitate their loan, get that loan back into a situation where they can actually afford to make the payment, and then give them a custom loan. We don't put everybody into one box. We put them into a custom loan that allows them to make that payment, and what the effects of that are is significant FICO benefits recovery for both the borrower and the co-borrower, and with that they see life-changing opportunity come their way. So I'll explain the investment opportunity towards the end. I want to really just tell you a little bit about how we do what we do. Okay. So YRefi borrowers are, again, they're looking for a solution that they do not think it's out there. We've been doing this for 5 years, and as of September 1st, 5 years, 9 months. So we've been in the business for a while, and as I indicated in my bio, if you will, the ownership in the company, myself included, and our executive team, they've been in this industry for a very long time. The executive team alone has got well over 250 years experience in education finance, student lending, compliance, capital raise in my world. These are people that really understand education finance and student loans, and they understand how to do what we're doing. So we build this product where a borrower is in a situation that they're in distress. So let's talk about how they got there. Student goes to school. First stop is the student financial aid office, right? They hit the student financial aid office and they fill out what's called the free application for federal student aid, also known as the FAFSA application. Now that FAFSA application is only telling them how much money the government is willing to loan them to go to school. Couple that with any scholarships and grants and of that nature, and then they look at the situation. They say, okay, you wanted to become a whatever. You don't have enough money, so let us introduce you to this private bank. Okay, so they go into the private bank. Private bank says, hey, our loans are FICO driven. You're a young kid, you don't have a FICO score yet, so mom, dad, grandma, grandpa, you come in and co-sign this loan. Kid goes to school for however many years. They come out on the other end, and I'm just going to make an example. Kid comes out with $100,000 in private student loan debt. Okay. The stories are wide, and frankly, they're hard to listen to on the phone, and I'll tell you about that in a moment as well. But what happens is the borrower comes out of school and something happens. Maybe they've made a few payments, Okay, because they graduate, right? And they get this little coupon book in the mail that says, hey, you borrowed $100,000 from us. Congratulations. You graduated. You owe us $100,000. It was a variable interest rate, somewhere between probably 4 and 9% based on FICO. You've got 30, 60, 90 days to start making your payments. Here's your coupon book. Go. Well, sometimes they make that payment. Sometimes things happen. Maybe they didn't get the job. Maybe the job doesn't pay what they thought it was going to pay. Any number of reasons. Okay. Well, then they go into distress. Now, when you're late on a payment, you get a late payment charge. That happens for several months, and depending on the lending institution, that could be 3 months, 6 months, 9 months, where you're just building up more and more fees. Well, at some point, as you roll into default, now you get hit with the default interest rate. Now they're in double digits. Then they find themselves in front of a lawyer, and now you're getting hit with lawyer fees. Well, you're all of a sudden this $100,000 loan that you had for 4 or 5%, and you couldn't afford the payments at that moment, all of a sudden has a 20% plus interest rate, and it's unaffordable. Now the collection company has destroyed your credit, and they're calling you up saying, hey, you need to send us $2,000 a month. They can't do it. So they're just checking out. And they're trying to figure out how to go through life with this ruined credit. So that's kind of how they get from A to B and how they find themselves in our situation. Now, how do we find our borrowers? Because a lot of people ask us, are you guys doing those robocalls? That is not why refi. We make no outbound phone calls. Our borrowers come to us through pay-per-click. So they'll find us on the internet through keyword searches and go to that borrower website. They will find us through, we do direct mail. We pull information from TransUnion, Experian, and Equifax. We send a little postcard to them that says, in essence, you have a problem, we have a solution, here's our number. Call us, please. The last one is we work with about 125 lenders, servicers, collection agencies, and law firms that know that they cannot help the borrower, but we can. So they will do a live transfer of the borrower from their call floor to our call floor every day. We're having record months right now. Again, I'll talk about that here in a moment, but we then explain our program to the borrower. Okay, now the underwriting portion of this is very important, and I'm gonna dig into that. When we take on a new borrower, the process that we put that borrower through is pretty rigorous. It's similar to getting a mortgage, okay, minus the FICO score, okay, because we already know that their FICO is bad. If you look at these borrowers, the majority, if not 100% of their debt is their student loan debt. It's not consumer debt. They never got an opportunity to get their financial bearing, so they don't own homes. If they have a car loan, it's usually very small. Same with consumer debt. It's usually very small if they have it at all. So it's their student loans that have really created this massive problem for them. So we underwrite on things like free cash flow, debt to income ratio. How long have you been at your job? What do you do? Okay, FICO is not a factor in our underwriting. FICO is Fair Isaacson's assessment of whether or not someone will pay you back. And if you look at our default rates, which are sitting at 100, we're literally have a default rate of 1%. And all of our portfolios combined, our borrowers are paying us back. And you'll see why here in a moment. FICO missed the mark on these folks. It's that simple. And maybe it's the way we underwrite. Okay, so borrower does the application, submits their document, and I'm going to throw out some statistics on our portfolio while I'm talking here. 70% of our borrowers come with a co-borrower. Mom, dad, grandma, grandpa, someone has signed on that loan with the borrower. And remember, it's all bankruptcy protected, so they're in the same boat as the student was or is, okay? So we pull credit, we identify what their debt load looks like, specifically their student loan debt load, and we calculate what their estimated payment would be with us in the event we approved a loan, okay? We then require the borrower to set up an escrow account and make it via ACH only. We don't take cash or checks, wheelbarrows full of pennies, none of that. It's ACH only. And what they then do is we set them up to start making that payment every month until we get them through underwriting. We require a minimum of 2 months payment, okay? We average about 6.5 while we're underwriting these borrowers, okay? Now, the reason I'm telling you this, and it's so significant, is this is the borrower's opportunity to prove to us that they have the willingness, and more importantly, the ability to pay us back if we approved a loan. Our average borrower comes to us with a low 500, high 400 FICO score, okay? Average co-borrower, low 600, high 500 FICO score. Now, Again, we don't underwrite on FICO. We do look at it, and it's very interesting to us. And we did not get in the business of repairing people's credit. That is not what we do. We get in the business to get people out of their student loan debt. What we discovered as an unintended benefit to these borrowers was within 6 to 9 months of us funding a loan, that's our average, we see a 125-point FICO bump for the borrower and 138 on average for a co-borrower. That's a meaningful change. Okay, we all know FICO drives everything, right? Your ability to buy a house, get a car, get a credit card, live a responsible life. When these borrowers start seeing their FICO score jump up, all of a sudden everything else gets affected, right? Even insurance rates are driven FICO driven to some degree, okay, auto and so forth. So these are generally speaking, they're just massive impactful changes across the spectrum, not just on their student loans. It just started with their student loans, okay? And the other reason I think is because they don't have a lot of other debt, right? This is going in the right direction, and that shifts the entire tide of what's going on in their lives. So I share all of that with you because at this point now we've approved the borrower, they're in the system, they're making their payments, they're making their extra payments when they can or do. And now we get asked the question, and I'm gonna try and answer some of our most commonly asked questions. First one we get is, what happens if the federal government forgives student loan debt? So let's address that right up front. There's two types of debt, as I mentioned before. There's the federal side, and then there's the private side. Sadly, politicians won't identify the difference because they're looking for something other than, they're looking for votes. Let's just be clear. At the end of the day, the federal government can only address forgiveness on federal student loans. Private loans is not their money. That'd be like me saying, hey, Ramez, your mortgage, it's paid off. No one cares until I write that check. This is private money. So the federal government cannot forgive private loans unless they write the check. And if they did that, they write us a check for the value of our portfolio. All of our investors get paid back. End of story. Sad for us. We're now, our market goes away. They're not going to do that, guys. You're talking about way too much money for them to do that. They can't even agree on what they're doing right now with the federal loans. The next question we get a lot is, well, what happens if the Congress changes the bankruptcy protection laws? Now what? How's my money protected if I'm investing in these loans and all of a sudden there's no bankruptcy protection? And the answer is, what we've done to protect our portfolio as best we possibly can, our average borrower indebtedness, or the size of our average borrower loan, is right around $40,000. These are not massive loans. Do we have a few larger ones? Yes, of course we do. We also have a lot of smaller ones. We are underwriting these borrowers very, very carefully on the front end, and most of them have a co-borrow, about 70%, as I indicated earlier. Okay, now with that, let's pretend that they changed the bankruptcy laws and said student loans are now forgivable in bankruptcy. What has to happen is the borrower would go into a bankruptcy court and prove to a judge that they could no longer afford that low fixed interest rate custom term loan that they were underwritten for and could afford when they took it out. So something big must have happened and changed. Okay, great. You're out of the loan, kid. Mom and dad, you're going to have to declare bankruptcy as well. That's the other reason we push that co-borrow rate up. So is there outliers? There's always outliers. We're not terribly concerned about bankruptcy laws changing. I don't even think it's on the docket right now, but we do address the matter in how we manage our portfolio. This is what we call a tear sheet, and I'd like to introduce you all to Joe. Joe Sable is our VP of Investor Relations. After we're done here, you're welcome to reach out to Joe. He can answer any follow-up questions. And obviously, if you need to talk with me, Joe can make that happen as well. So how is this investment structured? This is what's called a Regulation D 506C. So it is what's called an exempt security. It is filed with the Securities Exchange Commission, and it is for accredited investors only. Okay, and we can talk about what an accredited investor is. For an individual, long story short, it's $1 million net worth exclusive of your primary residence, or, this is not an and statement, or $200,000 a year of income for, I believe it's the last 2 years for a single person, or $300,000 if you are married. If you're an LLC or a trust, the rules change slightly. And yes, we can hold account title in IRA, obviously we're here, as well as individual trust, LLC, partnerships, etc. But that's that. So minimum investment.
One question, I'm sorry to cut off. Does that change for IRAs? Just out of curiosity, if you have a solo 401k or an IRA, does that minimum at all change, or do you have the authority to do that, or just is it a flat 50?
It's a flat 50.
Okay.
And yeah, so yeah, flat 50. Minimum investments at 50,000. And then here's what we did. And some of this comes from my years of experience as a financial advisor, knowing what the tools were that were available to us as financial advisors. And, you know, one of the things that advisors are tasked with sometimes is to build what's called an income ladder for their clients. Okay. An income ladder is where you place money in different, I'm going to call them tranches or buckets of money, and you can turn that income on at different times. So what we said was, let's build that in one single product, because it doesn't exist, right? If an advisor wants to do that, they got to go out and get it from a bunch of different companies, different products, then they got to manage it all. Let's build something that makes sense to the investor as well as the RIA, the registered investment advisor. So what you do here is as the investor is you pick the duration of your investment from 1 to 5 years. Yes, you can mix and match. Yes, you can put some in all. Okay, and I'm going to use an example. Investor puts $100,000 in each tranche. Okay, 500,000 total in this example. Now, what we do is we structure the front end similar to a bond, in that we make monthly payments of interest income only, and at the end of your term, you get your money back. That's how a bond works. Okay, these are promissory notes, but that is how a bond works. And that's what our product actually does. Now, where we got creative was we said, let's give the investor the ability to go into each individual tranche as often as monthly and make changes to their investment. You can turn that income on or off, up or down in 1% increments, as often as monthly. And if you turn it off, it's just reinvesting or compounding in whatever tranche the money is in. So my example is this: 100,000 in each tranche. Investor says, I want income from the 1, the 3, and the 5. I want to compound the 2 and the 4. Done. Next month, they say, I need a little more income. I'll take the 1, the 3, and the 5, and I'll take 32% of the income from the 4-year and compound the balance. Done. Do it right on our investor portal. Next month comes along, they say, I don't need any income. Turn it all off. Done. That is how flexible we have built this. Okay. We've built all of the modeling and the engines behind it. It's all done electronically. It's not us putting it on a spreadsheet on a wall. It's very, very cool. Is the technology that drives this. So that's how the investment itself works. Now, just so you know, we do compound daily and pay monthly. And these are annualized interest rates net to the investor. There's no fees taken out of this. This is what the investor actually does receive. Okay, and obviously if you're compounding, it's higher because you're compounding and we're paying you interest on your interest. What is the liquidity feature? Now, if you're in an IRA, hopefully you don't need to worry about this, but the liquidity feature is structured very similar to a CD. What I mean by that is if you are, I'll turn that off so I can see, y'all see me. If you are in the, what we do is if you had to cash out a partial or full investment, we recapture the interest only. There is no attack on principal. Okay, now, if you're in the 1-year note, you're 3 months in and you cash out, that's opportunity cost, whatever. It's not a big deal. If you're in the 5-year note and you're 4.5 years in, don't do that. Let's talk. Let's figure out a way to get you through that next 6 months. You know, you're almost there. I don't want to see you lose 4.5 years of interest, because the answer to the question is yes, it's all of the interest. Okay. Now, if we've paid it, okay, we capture it on the payout. You know, we paid you $5,000 in interest and on $100,000 and you cash in, we're going to send you a check for $95,000. Okay. Those longer terms are like that for a reason. Now, the other side of that, what we've done to offset that, and I'm going to go back to sharing my screen here if I can. What we've offered here is called a roll-up, and a roll-up is very simply defined. If you are in the 1, 2, 3, or 4-year note, at the end of your term, we lock in or ensconce all of your interest. You cannot lose it, and then you can roll up to anything above you. And I'll give you a quick example. Let's say you have $100,000 in the 3-year note. Okay, you pay maybe you took the income, the 7.5%. Maybe you compounded. Doesn't matter. It's irrelevant. At the end of 3 years, you say, you know what? I like this. I'm helping people. I make a good return. The income is nice. I'd sure like to move to that 5-year note. I don't want to be in for 5 years. 5 years, that's a long time. What we'll then do is we'll allow you to roll up from the 3 to the 5, and we'll give you 2 years in this example at 10.25. So you have the first 3 at 7.5, the second 2 at 10.25. If you needed to surrender in those last 2 years, it's a 2-year surrender charge. And remember, what you earned previous is all locked in. You don't lose that. Okay. So we literally have clients that started in the 1 year, they just came due and they have rolled. One person rolled to the 3 and the 5, another person rolled to the 2 and the 3. So you can roll up to anything above you. That's how flexible the product itself is. Now, what's also important to know, this is in what's called a secured collateralized portfolio. What does that mean? Long story short, a secured collateralized portfolio is where there's a big long legal document basically says, in the event we default on our payments to any investor, the portfolio goes to an independent third-party collateral agent. Their job is to make the investors whole. How do they make the investors whole? They take the asset, which is the portfolio of bankruptcy protected student loans, okay, that is leveraged very heavily in the favor of the investors at about 3 to 1, 2.5 to 1. Because remember, we're buying at 35 on average, and we're refinancing at 105. So there's that massive spread, right? You put in 100,000, we're going to turn that into 250 to 300,000 ish dollars of private student loan debt. That debt gets sold to pay back the investors, or they collect on it to pay back the investors, or maybe they sell a portion and collect on the balance. Whatever's in the best interest of the investors at that point, YRefi has lost control because we defaulted. Okay, so that's what secured collateralized means. Last but not least, I know you're going to talk about it just a touch. If I can find it, here it is. I'll share this with you because it's kind of cool. You blow that up and share my screen. This is our investor portal. It is investYRefi.com. I invite you to go check it out. We just launched our new investor portal on the back end. That will ask you to send a contact card to me. I will call you and set up an investor account so that you can access the PPM. You can go with the private placement memorandum, and you can see the subscription documents. And then, of course, Joe and I are there to help you get through all of that. That's what we do. But we're really here to share our story. You know, if you love it, great. If you don't, well, hopefully we made a friend, right? At the end of the day, that's really what we're here for, is to do good. And frankly, do well by doing good, right? Everybody wins.
Lane, thank you again, buddy. This was
my
so
pleasure.
I gotta have
Thank
you back on
everybody, for
board.
being here.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.